Welcome traders to the education part 4, where supply and demand zones will be explained and shown. Let's begin. There are two types of supply and demand zones. We have static zones and dynamic zones. The static zones are the overnight high and the overnight low, the settlement price, and the yellow lines, the yellow support and resistance lines. In the dynamic zones, we have the moving average, or the VWAP. Then we have the magenta SR line. All of these lines will be explained in this lesson. Let's begin. Before we proceed, we read the disclaimer. The information contained in this website is solely for educational purposes and does not constitute investment advice. The risk of trading in the securities market can be substantial. Therefore, you must review and agree to our disclaimer before using this site. If you have not read the complete disclaimer in the lessons before, you can stop the video right here and go through the disclaimer. But we will now proceed. Traders determine the support and resistance levels of a security by looking left and analyzing its historical price movements and identifying key levels where the price has previously reversed direction. The support level is the price at which a security has historically found support, meaning that the price has tended to bounce back up after reaching that level. Traders will often draw a zone at previous support levels. The resistance level is the price at which a security has historically encountered resistance, meaning that the price has tended to fall back down after reaching that level. Traders will often draw a zone to represent resistance at those price levels. Traders will then use these support and resistance levels to help make trading decisions. For example, if a security price is approaching a support level, a trader may consider buying the security, anticipating that the price will bounce back up from that level. Conversely, if a security's price is approaching a resistance level, a trader may consider selling the security, anticipating that the price will fall back down from that level. It's important to note that support and resistance levels are not always exact and can be broken, leading to a change in the security's trend. Therefore, traders will often use other technical analysis tools in combination with support and resistance levels to make a more informed trading decision. Let's look at some examples in the next slide. There is a rule that when a level is broken, then previous support will tend to act as resistance in the future, and previous resistance will tend to act as support in the future, as shown on the graph in the left. Here we have, this is a support line. The price has come down, it bounces up, comes down, it bounces again up until it breaks the support level. Then this support level becomes resistance, as shown in the graph. Similarly, if you have a resistance level, every time price reaches the resistance level, price comes down. Reaches the resistance level, price comes down. Once this resistance level is broken, this resistance now becomes support. This support and resistance level proved to be very reliable because everybody uses them, and therefore will help you trade on the same side as the professionals and increase therefore your accuracy. By looking left at the price history, you will be able to find these levels, which will provide you with some clues as to the support and resistance zones. Previous support is where the buyers sweep sellers, providing a good buying opportunity, and previous resistance is where sellers sweep buyers, providing a good selling opportunity. When price reaches a resistance zone and you get a signal like sellers sweep buyers, on the range chart you have a higher probability of success. The price reaches a resistance zone and the sellers take over and bring the price down. Here, price has reached also this resistance zone and then will tend to come down. Similarly, when price reaches a support zone and you get a signal like buyers sweep sellers, on the range chart you have also a higher probability of success. Let's now look at some of these zones in the chart provided. In the static level, we have the overnight high and overnight low price zones. The overnight high, okay, is the maximum price reached, okay, since 1800 hours the day before and the opening session for that particular instrument. This zone, okay, is printed as two dotted lines in red color, and the numerical price, the highest price reached, is printed in numbers, okay, at 9:30 in the morning. If we're talking about the equities indices like the ES, S&P 500, the Nasdaq 100, the Russell 2000, or the Dow. Similarly, okay, the overnight low price zones is also printed at 9:30 in the morning for the equity indices, and it represents the lowest price reached between 1800 hours and the start of the New York opening session. A yellow vertical line is also printed here, showing the start of the New York session at 9:30 in the morning, and it will always be shown at the close of the New York session for that particular instrument. The difference between the two dotted lines is just 1 bar. In other words, if the range is 4, the difference will be 4 ticks. If this bar has a range of 10, then the difference between the two lines will be 10 ticks. The settlement price. The settlement price is the average price of a financial instrument at the end of a trading day. The settlement price or closing price will vary based on product-specific factors. For example, the closing time for the indices is 1600 or 4 o'clock in the afternoon New York time. For aluminum is 12 o'clock. For treasuries is 1500 or 3 o'clock p.m. grains is 14.15, and so on. In some financial instruments, such as oil, the settlement price is the average price of the last 5 minutes of trading. The settlement price for each instrument is printed as a blue dotted line before the start of the New York session for that instrument, and the numerical settlement price is printed at the beginning of the line, right here. If price is below the settlement price line, it will tend to act as resistance in the future. And if price is above the settlement price line, it will tend to act as support in the future. Often, after the beginning of the regular session, the market will try to return to this line if the price is too far above or below it. Note, because range bars are not time-based, the settlement price is an approximate value from the actual closing price of an instrument, since the range bar does not usually close at exactly the same time as the market closes. For example, in the indices, the closing time is 1600, but the range bar is not time dependent. Therefore, that bar might close at 1601 or 1602. Therefore, the settlement price line will not be exactly the same as the closing price at the market, okay? But it's only an approximate value. More static lines. We have incorporated in the chart static support and resistance dotted lines in yellow color. These lines represent areas where the price has either acted as support or resistance in the past. These lines are extended to the right only if there has been a price rejection at that level more than one time. Here we have some yellow lines we have been extended because price has touched that level more than once. If there has been support or resistance at that level more than once, the yellow dotted lines will be extended to the right. The more times that prices come near that extended yellow line and there has been price rejection at that level, the bigger the dots will be in order to draw the trader's attention to that particular area as shown below. In other words, they start, if at this level the price has reached this level more than once, then this line is extended to the right. But the more times it reaches that level, okay, as in this case, then the dots get a little bit thicker. Here, prices come to this level and it has bounced off this level either as a support or resistance level many times. Exactly just the same as here. Acted here as resistance, acted here as support. So this line, the dots in this line are thicker than other lines shown on the graph, on the chart. Volume weighted average price. The VWAP line, okay, is a technical analysis tool used to measure the average price at which a security has traded throughout the day based on both volume and price. The VWAP line is calculated by multiplying the price of each transaction by its volume and then adding up all the total values of all transactions. The total value is then divided by the total volume of shares or contracts traded to arrive at the VWAP line price. Let's see the formula. Here we have the VWAP is the sum of price times volume. So at each price, okay, you multiply by the volume, okay, of shares traded at that price, and then divide by the total volume of shares in a particular time interval. Here we have, for example, the total value of all transactions, price times volume, gives me the total value of all transactions, and the sum of the volume is the total volume of shares or contracts traded. In other words, we multiplied the volume at each price and divided by the total volume. That will give us the VWAP line, and that is a dynamic line because it changes with time. Traders often use the VWAP line as a benchmark for whether the current price of a security is trading above or below its average price for the day. If the price crosses the VWAP line from below, it may indicate the beginning of a bullish trend. If the price crosses from above, it may indicate the beginning of a bearish trend. The volume weighted average price line is important because it provides traders with insights into both the trend and the value of a security. Our VWAP line starts at midnight, New York time, that's 00, and ends at 23:59 on the same day, except on Sundays, when it continues from the previous trading day at 1800 and then restarts again at midnight to plot the VWAP for that new day. The slope of the VWAP line will also show the trader the current trend of the market, increasing or decreasing in price. Our VWAP line is plotted in two colors. It will plot red if the price is below the line, and it will plot blue if price is above the line. Now we have some dynamic lines, dynamic supported resistance lines. The line that you see here in magenta color, okay, is a moving average line, okay, which tends to act as support if price is above the line, and will tend to act as resistance if price is below the line. The price, okay, the SR magenta line also gives us the medium-term trend. If price is above the line, then there is a bullish trend. If price is below the line, it is a bearish trend. The SR magenta line will tend to act as support in the future if price is above the line, and it will tend to act as resistance in the future if price is below the line. When price crosses the magenta line, like in this case, okay, it used to be resistance, now a support, okay, and we can expect the price to go up. In this case, price is below the line, every time it reaches the line, it will tend to come down unless it crosses this line upward. Here we have two more lines, which are dynamic lines, are moving averages. One is an EMA, an exponential moving average, and the other one is an SMA, or a slow moving average. If the lines are going down, then they will turn white, and if the lines are going up, they will turn green. If both lines are white, then you have a downtrend. If both lines are green, then you have an uptrend. If the lines are close together, like in this case, you have a consolidation, because you have here green, white, red, green, white, 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 green. The color varies between white and green. This indicates that this consolidation, that you'll get a lot of buying and selling close together. Don't guess what the market will do. To enter the market, it is important to know which of the two forces, the buying or the selling, is the predominant force at a specific moment, so that you can trade in the direction of the trend, if there is one. If the market moves sideways, both buyers and sellers will try to control the market, and you will get buying and selling signals close to each other. Then it is better to stay on the sidelines and see what the market will do next. Trading and gambling are very similar in the sense that the outcome is uncertain. Therefore, it is important to have a method that will put the odds in your favor, and you must use that method all the time independently of the outcome. With our framework, you no longer need to guess the direction of the market, since the rate bar X-ray chart takes into account a confluence of indicators that will provide you with the sentiment of the market at any moment, in order for you to make a more informed decision. In part 5, you will see the complete chart where the MACD, the volume versus price histogram, background colors, higher highs and higher lows, and automatic trend lines are incorporated and explained. So I'll see you in part 5.